Welcome to the June 2025 monthly motor checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist here at Motor Capital Management and Research. This month, we're going to talk about the Tactical Trends Balancing Act. So, this is a theme I've been touching on for quite a while. We clearly have structure for the short term that's allowed for higher highs. We're actually seeing the S&P break out to new highs, but all of that is taking place within the context of still negative medium-term structure and very neutral, leaning towards negative longer term quarterly time frame structure. So the idea is we need to see this balancing act result in repair of those higher time frames. Otherwise, eventually the short term will fumble the ball, will give back the ball to the higher time frames. And the condition of those time frames at the time of change of possession will dictate what's next for the market. And so we need to see that all repaired before that change in possession takes place. The Tactical Trends Balancing Act, so the short-term time frame has the ball, and trend structure there remains good enough to warrant a fully invested long position with higher highs for the S&P and hopefully the average stock still in focus. In that context, the good news is that tech continues to improve, and semiconductors in particular, while the capital goods group retains their already strong position within the industrial sector. That said, we have yet to see this translate into broad, longer term improvement. We did a lot of damage during the February, and March and April decline. We broke a lot of long-term monthly charts, and those charts are still broken. So in that regard, most stocks are still in a monthly time frame downtrend. In the defensive groups continue to lead on balance. So what we need is we need to fix this bigger picture uh, as this shorter term trend plays out. And we need to do that before the tactical trend rolls over, as it always does. Tactical trends never last forever. So when this thing rolls over, we need to be able to do that into the context of repaired, improved long-term structure. So if we can do that, then we'll just stay long and cover whatever short exposure we have. Otherwise, we will expand our short exposure from where it is today as the tactical trend rolls over. So we're just going to kind of walk you through the data that supports the view, as well as what we're monitoring for indication as to whether or not that short-term trend is fixing all the broken long-term charts. So let's dive into the structure of the market currently, and what we can see by looking at the moving average configuration today. These are the 27 motor groups sorted best to worst. And let's just jump right off the cliff here with what's not good. And that is that this has been something that's been ongoing for quite a while outside of IT hardware and capital goods, arguably two cyclical groups. So we need to be mindful of that. As I always say, in the throes of a bear market or a very highly volatile period, let's pay attention to what's outperforming despite the volatility, because that's likely future leadership. So I think we have a pretty good indication from these two groups that we should be paying attention to them for future leadership. But that aside, when we look at the broad market, when we look at the percentage of stocks in the motor universe, which is about 2,900 companies with a rising 200-day moving average, we can see that only 48% has a rising 200-day moving average. And then the percentage of stocks above the various moving averages, we can see that only 46% are above the 200-day average, and then 70 and 61% are above the 50-day and 15-day respectively. So this is structurally not good structure, and then in the context of a potentially overbought condition. And then when you look at all the groups that have in this framework have good structure, all of them but these two again are defensive. So just at a very high level, this is not what you really want to see from a market that has higher level broken structure, which we can see here. So this is the trend model, and focusing on the quarterly time frame. And when we look at the percentage of stocks that are in an uptrend in the quarterly time frame, we can see that this is arguably, it beats a sharp stick in the eye. It's 56%. So it's not a vast majority in a downtrend. So this is still salvageable, but nonetheless, it is still only 56%, which means that 44% looks something like this, or at best like this. And then only 43% of all the charts have positive momentum. So they're in one of the negative momentum categories, which would be this one, or this one. And then when you look at the broad market, again, these trends. So here are the six trend buckets for software services. For as an example, this one's colored blue because of the six trend buckets. It's the biggest one. So when we look at the broad market, we can see that the biggest trend bucket in the broad market is this one, which is a clear downtrend on the quarterly chart now. Keep that in mind, so that's the biggest trend bucket on the quarterly time frame looks like this. This is just not the ingredients for a strong bull market. So this is where we are. This is what we're rallying into, and we need to see a lot more repair to this broken structure than what we've seen so far. And unfortunately, that short-term time frame is starting to thin out, as I'll show you in a moment. So we're starting to lose the underpinnings of this short-term structure of the short-term structure of this rally that we're experiencing, and the risk is that we're going to roll over in that short-term time frame into this structure, which of course would not be a good thing, as it wasn't back in February, the last time the short-term time frame rolled over into negative structure. This can't get better. This time frame cannot get better until the next lower time frame gets better first. So we can look at that. We can just drill down on that and see how is this time frame doing. So this is the quarterly time frame. Here, that's the quarterly chart. This is the monthly chart. So this is a very long-term chart, very significant chart. In this time frame, only 44% of those charts look anything like this or this. And that's the flip side, or the other way to say that is 56% look like this or this on the monthly chart. So we've done a lot of we've made a lot of noise, I guess we could say, rallying across the range. And despite all that noise, we still have a very broken environment in the quarterly and monthly timeframes. Now, when we look at the short-term charts of the 2,900 stocks and we bucket them according to where they are today, here's where the good news is. A couple of things we can say. One is 67% of the short-term charts look something like this or like this in a context of an uptrend. So that's good. And in that context, the biggest trend bucket looks like this. No consolidation going on at all. So it's just a pure, clear uptrend. That's the good news. The bad news, if we were to point to the bad news, would be that a month ago, this number was in the 80s. It's now in the 60s, which means that it's come from one of these three trending buckets into one of these three downtrending buckets. That's been the sort of the transition. So this isn't just getting thinner in terms of like stocks hitting new highs. We actually have stocks that are rolling over, and we're losing this number. It used to be in the 80s. It's still strong enough and it's still robust enough. Most of these groups have positive momentum. So we still have potentially time on our side to reaccelerate and get this number back up into the 80s again, which would be wonderful. But at the margin right now, that's not what's happening. It's actually beginning to roll over and deteriorate in the short term. So again, not enough to warrant a short position, a meaningful short position as it was back in January and February, which was our first short exposure since early 2023. But it's definitely rolling over into a context that is certainly, of the type of long-term structure that could easily result in another meaningful downswing if and when this time frame rolls over. Thanks so much for watching this clip of the monthly motor checkup video. We appreciate your interest in our research, and we hope that you are finding it helpful and informative. If you'd like to continue watching this video, as well as access our most recent monthly motor checkup, sign up for a free 30-day trial to all of our research at motorcmr.com. You'll find a link to our website in the description below. As always, like and subscribe to be notified of future content.